Hello, everyone. Happy Monday. It's April 17th. Today on the Final Bar, we're going to talk about this market environment. Nice acceleration to the upside into the close. Some stocks really getting it done. Enphase Energy, some of the emerging renewable energy names come to mind. Others struggling like State Street. Let's break down all the charts together on the Final Bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. How are you? Welcome to the show today. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit has really helped you to understand, or designed to help you to understand, not just why things are happening or how things are happening, but what is actually moving, focusing on trends, focusing on how those trends evolve, and identifying and anticipating when those trends may be reversing. Some interesting charts with a bit of a reversal sign. One of our questions from the mailbag a little later in today's show talks about semiconductors, a bit of a bearish momentum divergence, which we'll share with you, show you what it actually means and how it might impact what has been one of the leading groups year to date so far. Let's get to all these charts and more in our market recap. Let's look at the evidence using the StockCharts platform. We'll start looking at the major equity averages, and you can see the S&P is up about 1/3% going into the close. S&P finishing just above 4150, around 4151. The Nasdaq Composite up about 0.3%, the same for the Dow. So not really a differentiation much between those three major U.S. equity indices. Mid caps and small caps both outperforming the S&P and the Nasdaq through the course of the day today. Mid caps leading the way about 0.75% higher. The mega cap S&P 100 index only up about 0.2%. Nasdaq 100 flat for the day, and you might see when we look at the phenomena stocks, or what I call the FANG stocks, some weakness in there, particularly names like Netflix actually down a bit today, and it's weighing on the Nasdaq 100 for sure. The VIX continuing to push lower. It's down below 17. And what's interesting about that is 2021 saw the market rallying on lower volatility. We haven't seen that environment really since the summer, early fall of 2021. Are we returning to that sort of environment? That's an open question, but I think it's something certainly to pay attention to. As we look at just the little preview chart of the S&P 500, you can see the acceleration in the last 2 hours, starting around 2 p.m. Eastern into the close. Went from a down day, closing around 4125, to an up day, just narrowly closing just above 4150. Let's look at some other asset classes here very quickly and just see what can be seen. Interest rates overall moving higher. That's across the curve from the short end to the long end. The 10-year yield, which is the point we usually focus on, just below 3.6%. Bond prices have stalled out a bit. You can see the TLT was down 1.2%. I think it's one of the interesting narratives. We'll get to that chart here in a few moments, but the fact that bond prices have stalled out, there have been a number of times where the TLT, the AG, which are two of the more liquid bond ETFs, have attempted to break out above resistance. They've failed to do so, and this most recently is just the latest drawdown after attempting to make a new high for the year. Commodities here very quickly, you can see down a bit, although there were a couple contracts that were actually up on the day. One of the ones we focus on a lot, or two of them, are gold and silver. Gold actually down 0.4%, silver down 1.2%. It's using some of the commodity ETFs that are widely followed and fairly liquid. The USO, which is a crude oil ETF, was down 1.7%. Same can be said for gasoline. Looking at cryptocurrencies, you can see for the most part in the red today, but again, coming off of pretty elevated levels. Ether still above 2,000, and we talked about that level for so long, right? I kept that every time we were looking at the Ethereum quote. It was down in the 1,600, 1,700, 1,800 kind of range. Just kept talking about that 2,000 level. Now we've broken above there, pulled back a little bit, but overall still remaining pretty high relative to where it's been over the last 6 months or so. Bitcoin as well, back below 30,000, down 2.7% today, and over the weekend sort of rolled over going into the equity trading day. 30,000 is sort of an important level to pay attention to, certainly on the chart of Bitcoin. Let us look at a daily chart of the S&P 500, see what we can see. and then kind of go from there. So here's what things look like. If you look back at the last year, year plus a bit, you can see that we came down, of course, through the course of most of 2022. That higher low in December was pretty important, and that was coming off of the new low in October. So we made that higher low around 3,800. We retested that support level in March. And the fact that we've now established that level and retested it tells me that's a pretty meaningful level. That's why we have this green shaded area down there. The reason why I'm starting there is I'm often asked, like, if things would roll over, then what? And my answer to that question today would be not much until we get below S&P 3,800, because I would interpret the market over the last 4 to 5 months as being sideways, right? We're at the upper end of a range, but we're still in a range from around 3,800 to 41 to 4,200 on the upper end. So we're in the upper end of this rectangle pattern, but we're still within it. And so I think getting outside of here, holding 4,100 on a breakout, which so far we are doing, would be step one. Getting above 4,200 really clears the way to retest the August 22 highs and certainly could open the way to further appreciation, which seasonality would tell us is actually the most likely scenario, right? Look at the seasonal trends. Think back to my conversation with Jeff Hirsch earlier this year. That was back in January. We talked about sort of a general trend in a pre-election year. First half of the year actually tends to be pretty strong. April actually is the strongest month of the 12. So not surprising that we're seeing some strength right now. That's actually fairly normal for this time of year. The second half of the year actually tends to be pretty meager returns and a much less attractive average return for the S&P 500. So, if we would roll over, I immediately will start talking about things like the 3,800 level. Along the way, you have some moving average support to pay attention to. The 200-day around 3,950 might be a level to pay attention to as well. But for now, again, let's give credit where it's due. Market's going higher. Most bullish thing the market can do is go up. And I think at this point, you could probably say that that's been the case. Let's look at a couple other charts here. First, just very quickly on the sector side, you can see that real estate and financials were the top two sectors. Kind of an interesting thing to dig into here briefly. Again, we've talked about this a number of times. If you pick up skepticism in my presentations, in my voice, as I'm going through these charts, it's because when you have up days, but it's led by defensive sectors like real estate, it's not a feel-good, everything's in the clear, kind of normal bull market day. This is something a little different because REITs don't tend to lead in a bull market, right? They tend to be more defensive plays. People go to real estate when they're trying to get the income component, when they're going for lower volatility, more of a defensive positioning. That's when REITs tend to do a little bit better. Now, there are times when REITs have done fine in a bull market phase, but on average, it's not as common. So the fact that REITs are leading the way higher, up 2.3%, is a bit of a head scratcher. Financial second, up 1.2%. Now, what's interesting about both of those charts, by the way, these are charts that have been fairly beaten down, right? This is the chart of the real estate sector, the XLRE. And when I say they're beaten down, I'm really thinking of this chart at the bottom, which is the relative strength comparing the real estate sector versus the S&P 500. When this line is going up, that means the ratio is increasing, and that means real estate is outperforming the S&P 500. If the line is going down, which it has been fairly consistently for the last 12 months, with a notable exception here in the fourth quarter of last year, but overall the longer trend has been pretty negative. That shows you how real estate has been consistently underperforming. As a matter of fact, it's coming off of a new 12-month relative low just a couple weeks ago in mid-March, right? So we're bouncing off of the lows, as most things are off of the mid-March low. You have this nice sort of bullish engulfing pattern at the March low, sort of rallying off of there. Think of that as a retest of the October low. But for now, real estate is still below two downward sloping moving averages. Compare that to something like communication services or technology, which is above moving average support. These are below moving average resistance. So I would argue, get excited when real estate can get above the 200-day moving average and stay there. That's not what happened in January, February of this year. That's certainly not what happened in August of last year. And I think that's the challenge for something like real estate. So nice move off of the lows, but still, I would say, chart challenged. Now, financials are an interesting place to dig in here briefly because you've had a lot of earnings recently. A couple of them on Friday we had, like Citigroup and like Bank of America and JP Morgan, if I remember right. This week we have more. So we had State Street, Schwab, a bunch of names reporting earnings through the course of this week. Goldman Sachs, I think on Wednesday, if I remember, I don't have the list in front of me, but a number of companies actually reporting in the financial sector and others as well. You've got Tesla and others reporting this week as well. However, what's interesting about financials, similar to the real estate chart, nice rally, right, over the last couple weeks, off of mid-March to where we're at now, a nice bounce. And actually, the relative strength is actually starting to turn higher. The sector was oversold the second week in March because it had gone down. This is during the sort of mini financial crisis, the banking crisis that we experienced. Oversold condition alleviated there in mid-March, and from there it's been a nice rally, but still below moving averages. So again, I still see this as sort of a counter trend move off of the low, sort of a mean reversion play. What convinces you that it's something more significant? Well, I would say instead of being below moving average support, you need to be above it. Instead of rallying to support, you rally through it. Instead of the momentum coming out of oversold conditions, you need the momentum to be more positive. You need the relative strength to improve. So all of those things could play out. I'm just not seeing enough on the chart yet to get really excited about it. Now, when I think about something like financials, I'm immediately thinking of an indicator like PPO or MACD, which is more of a mean reversion indicator. My conversation with Joe Rabel last week comes to mind, or I think that might have been the week before. And when we were chatting about different charts, we were looking at the ADX line, looking at MACD crossovers on some weekly charts, and you can see that on the daily charts that a lot of the financial stocks, including the XLF, all had a buy signal in the fourth week of March, and overall sort of indicating beaten down scenario now alleviated and rotating higher, confirming this bounce. The question is the staying power, right? And what the upside is for a group like that is rallied. To the point that it has. What's interesting is in that same sector, you have things like Schwab, which are really still at the lows, right? Take this big aberration of a down day with a big intraday move off the table, and you can see that the lowest close was in just a week and a half ago in early April. What just happened today, though, besides the buy signal that you got from the PPO, besides the RSI starting to improve and a bullish momentum divergence going into the lows, if we look at a candle chart of Schwab, you can see today a bullish engulfing pattern. We haven't had a lot of these in a while. Bullish engulfing pattern is when you have a downtrend, you have a down day, an up day. Day two's range, the body open to close, engulfs the first day's body. That's a nice move higher and a nice indication of further upside potential. So interesting to see in the financial sector, nice rallies. Again, I'm concerned at a high level by the fact that the market's being led by some fairly defensive sectors like real estate and mean reversion plays, I would argue, like financials. Do those sectors have the staying power, the leadership potential to move higher? I'm not certain about that. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close for our show. Couple quick announcements before we open the Final Bar mailbag. First off, we very much welcome your feedback, but we especially welcome your questions. Our mailbag is driven from viewers like you sending in your questions. Email is the best way to get them to us. The Final Bar at StockCharts.com. We're on Twitter at Final Bar SCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. I hope to answer your question live on the air on Friday's show of this week. Upcoming schedule, we have some fantastic guests. We have the CMT Symposium coming up in New York next week, and we are featuring a series of CMT guests leading up to that, as we often do on the show. Tomorrow, on Tuesday the 18th, Ari Wald of Oppenheimer. On Wednesday the 19th, Craig Johnson of Piper Sandler. On Thursday, April 20th, Dan Russo of Potomac Funds will be coming back on the show. So some really good conversations, a lot of great interviews we've had recently are all at StockChartsTV.com. Also, to let you know, I will be doing an upcoming webinar tomorrow on Tuesday, April 18th at 1 o'clock Eastern called 3 Steps to Every Signal. I'm often asked about a particular chart. Someone sends me the chart and basically asks me, what do I do now, right? Is that the signal? How do I think about it? What do I do about it? What we're going to do is talk about how a technical signal, I would argue, has 3 pieces. We'll talk about each of those steps, how to identify them, how to trade around them, and basically how to better anticipate future movements in different prices. By the way, go to marketmisbehavior.com/3 steps to sign up for that free event coming up tomorrow, the 18th. Let's continue on our show today with the Final Bar mailbag. Please keep your great questions coming, and let's get to question number 1. Dave, what are your favorite indicators that help you decide when to buy or sell an investment? I love the simplicity and the straightforward nature of your question, and thanks for asking me. To be honest with you, I don't hide a whole lot. So the charts that I show you on the show are literally the ones that I use. And for those of you that are Market Misbehavior Premium members and get a lot of more of my premium content, you'll see that I use these charts often. I just share additional thoughts and insights using these same charts. The tools that I use looking at the chart of Netflix here are all driven by techniques and approaches that I have found have added value to my process. And a long time ago, over time, I think what happens as a technical analyst, as you grow as an investor, is you refine your technical toolkit. And so for me, the price with the 50 and 200-day moving averages has been the most basic way of analyzing price for me for the longest time, because it starts with Dow theory. Is the price in an uptrend or downtrend? I find a lot of times skip way past that part to their own detriment. Start very simple. Is the price going up or down? Are we seeing higher highs or lower highs? The fact that Netflix right now is potentially putting in a lower high at 350 is something that I picked up going into last week and into the weekend doing my review of the S&P 500 charts. I think that's an area of concern. So 350 immediately is a level to key in on a chart like Netflix. Having said that, we're above the 200-day moving average. Not a lot of good stuff happens below the 200-day. A lot of good things happen above, because an uptrend pushes you usually above the 200-day moving average. So recognizing the interplay between price patterns, support and resistance levels, and the moving averages are important to me. After that, it's RSI, which is a measure of momentum. And I think there are others that are perfectly fine for that, like stochastics. Like Williams %R is a pretty effective tool, but I think you only need one of them, and RSI is the one that I've found to use. And then arguably the most important thing on my chart is the relative strength series at the bottom. And this is a simple ratio of the stock or ETF I'm looking at versus a benchmark versus the S&P. If you were an individual investor or a financial advisor and you don't have that series at the bottom, you're missing out on one of the great tools that institutional investors use often, which is focusing on relative strength, focusing on leading stocks and ETFs and leaning away from lagging stocks and ETFs. So those are the tools that I tend to use. I have a lot of other things that I will look at occasionally, but I often come back to it. So 95% of the stocks or ETFs I look at, this is where I start, and then I go from there. And those are the techniques that I tend to use. I would encourage you to pay attention to the guests that we have coming through. We have a lot of guests that use a lot of different techniques. Find the ones that you find really have a good sense of things, where their approach lines up with your own. Those are the ones that I would encourage you to follow. Great question, by the way, and thanks for that one. Next one, I love this one. When doing your show, I notice you always have a tab of Home Depot HD on your screen. Is there a reason you follow HD? And I love this question, and there's a reason, and I'll tell you why. I often, and people would make fun of me when I was at Fidelity, because I would always bring up Home Depot as an example. And that actually came from my training as a technical analyst at Bloomberg, because you would always need to have a stock that you would use. It would be like your go-to name, just something you would use. So if someone asked you a question about a technical indicator or about, analysis in general, just let me bring up a name. So you needed something that was just liquid, that people kind of knew, but it wasn't like the most important one they ever followed. And I started using Home Depot. So I 90% of the time would have a chart of Home Depot open, and people always think that was like this subtle suggestion that I'm invested in Home Depot. And I have before, but not currently, and it's not something I'm personally advocating for any reason. But it's just a good example. I find it's liquid enough, it has good movements, it tends to trend, and all the things, any example indicator I would want to use probably works on Home Depot, and that is the short answer. But the takeaway from that, I would say, is have a group of stocks. In my mind, I look at Home Depot so often as a starting point just to think about things. I would encourage you to have a stock like that you're in, whether it's Apple or Tesla or something. Have a go-to name that's just pretty commonly understood. So if you're talking to someone else, you have a good starting point and a way to connect and really to apply a new indicator and think about how it relates to some of the indicators that you're using. So that is the short answer and long answer of why I have Home Depot. It's not any sort of recommendation of any sort, but just a good example that I think is easy to illustrate ideas. Next question. You mentioned the Coppock Curve indicator was better to confirm recovery than call a bottom. How would you interpret the current pattern? It's actually a really interesting question. You're asking that about last week. We featured the Coppock Curve, and we've talked about it a number of times actually recently. So let me bring that up. And let's see where I have it. I was going to say I have it in a couple different places. I actually think I put it on my monthly chart review. So this is the chart review that I use with my premium members. I'm pretty sure I popped it right there. There we go. So here is the Coppock Curve at the bottom. This is the monthly chart of the S&P, of the New York Composite Index, $NYA, and I use that with the Coppock Curve because that's what Sedge Coppock, actually used as for the indicator, and so I'm just staying true to the methodology he advocated for. The monthly PPO, pretty standard analysis using that technique, and then the Coppock Curve at the bottom. I think what you picked up on was my comment that it's better. The Coppock Curve usually signals a recovery. I think that's fine. I would say it's not as good for confirming a bottom only because it lags behind the bottom a little bit, right? So if you look at where the market actually bottomed in October of 2002 or in March of 2009, the Coppock curve doesn't signal on that moment because it has to wait for the price to actually rise enough to change the advanced decline lines to the point that the Coppock curve turns up. And you have to wait for the monthly close, which means you're automatically usually lagging a couple weeks just to get to the end of the month to be able to confirm the signal. So, it's not as much to identify, to cherry pick the bottom, but more to confirm that the bottom has happened, that morning period that we talked about is over. That's why, honestly, I use that Coppock curve, which is why I have this chart as part of our monthly chart review just to see where it's at. And I also have the monthly PPO because that's usually a little bit lagging. So if you look at these historical buy signals from the Coppock curve, you've actually waited a month or two before the MACD or the PPO actually gives a buy signal, right? So it actually happened a couple months later in 2003, a couple months later, maybe 3 months later in 2009. You can see pretty much every one of these times, the Coppock curve turns higher, which are the green vertical lines, and then a little bit later you get the buy signal from the PPO. So I actually use them together just to see if we do get a buy signal from the Coppock curve, which we did January into February of 2023. How does that relate to this monthly PPO? So the Coppock curve has generated a buy signal. I think that was in January. The monthly PPO is still bearish. It's actually not turned higher. So at this point, the Coppock curve is thumbs up. And the MACD indicator is not yet. So at this point, that's how I would interpret. Looking back at the history of the Coppock indicator, this tells me that the market's in an uptrend. And very rarely, and as a matter of fact, none of the times over the last 25 years have you had that sort of signal and then had the market make a new low soon after, right? At the very least, you're going higher for 6 months, if not, 60 months, right? There's some of the longer signals. So at this point, it tells me to be not so bearish. It's hard, though, when some of the evidence is clearly pointing to the market not going higher. But that is how I would interpret the current Coppock curve. It's bullish, right? Next question. Gold stocks are making higher highs on higher volumes. Same with semiconductors, but they have a negative RSI divergence. How should we interpret this? What I love about your question is you're picking up on the relationship between gold and gold stocks, and the movement in those stocks using something like divergences and how two groups doing well, the divergences can actually help you differentiate between the two. Let's look at the charts that I think tell the story you're implying. Here's the GDX. There are a couple other ETFs that we could use to track gold stocks. This is just one that comes to mind. We can see that the GDX made a new high for the year here in early April, breaking above 33. At this point, still remaining above there. Well, it got up to 36 actually last week. Came off a little bit going into the weekend. Noting here that it was overbought coming into today's session, but now out of that overbought region. So basically indicating at the very least a bit of a pullback. But you can see a lot of times we'll become overbought. We'll have a brief pullback. We can even make new highs, which is what we had here in March and April of last year. The reason why I wanted to point you back to this point is this is showing that bearish momentum divergence that you're asking about. Now, you mentioned it on semiconductors. We'll look at that in a bit, but worth noting that even on gold stocks, you actually have had this scenario before. We became overbought in March of 2022. We made a new high in April, but on lower momentum. Overbought on the first attempt, not overbought on the second attempt. We rotated lower. You can see here we do not have a divergence because we're making a new high. We're actually overbought. So if we would make another high and the RSI was not overbought, that would be what's called a bearish momentum divergence. Now, think about that as we look at the chart of the SMH, and you can see exactly what you're getting to. And what I would say is what that tells me is that gold stocks are setting up in a better configuration than semiconductors for this particular reason, right? You can see that the SMH is making a higher high February into March, but you can see that the RSI is actually sloping downwards, right? So overbought in February, not overbought here in late March, early April, new highs in price, lower peaks in momentum. So, and you actually saw the same pattern here at the end of 2021, higher highs in price here, higher highs in price there, lower peaks in momentum. So that bearish momentum divergence often happens at market tops, not just for the major averages, but on ETFs like the SMH and the GDX. They often tell you when there's an exhaustion of buyers, right? Not enough buying power to push the market to an overbought condition again. So I would argue that means gold is in a better position now versus semiconductors, even though both of them are coming off of a new swing high. The fact that there is a divergence for the semiconductors tells me to be more skeptical of further upside there. Great question, by the way, and thanks for bringing up that concept of leadership between some of those groups and thinking about the RSI. I'm concerned with the upside for semiconductors given that pattern. Final question, and actually we have to wrap it. Oh man, the 3 and 3 comes so quickly when we're having fun answering questions. Please keep your questions coming, though. We'll get to more at the end of this week. But we got to wrap the show, folks. The 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. When we talked about the VIX, we talk about lower volatility, and I mentioned in our market recap, the VIX is below 17. It's actually just below 17, around 1695 at the close today. I created this chart just to show you the relationship between what we're seeing now and what we saw in mid-2021. Look at what happened in 2020. Now, granted, very different environment. We were coming off a very elevated period of volatility with the VIX up in the 80s off the left side of this chart. It had settled down, but for most of 2020, as the market was recovering, the volatility remained fairly elevated, fluctuating between 20 or 25 on the lower end, up to like 35 to 40 on the upper end. Look at how that changed in the second quarter of 2021, where all of a sudden the volatility went lower. We got below a VIX of 20 and basically stayed there. We did have some times where we spiked up, but those were very buyable dips within a fairly low volatility uptrend. My question, I think an open question right now, is whether we are entering a similar period of volatility. We sort of went below 20, we spiked up, which is exactly what we did in May of 2021. Does that line up with March? And now we are here kind of in June of 2021, which is basically 6 more months of a nice consistent uptrend on fairly low volatility. That might be what we're seeing next. I think what would validate that for me, 2 things. The price, the S&P gets above 4,200, and the volatility, the VIX remains below 20 for the most part. I can't guarantee that it's going to happen, but I think that is a historical analog that I'm looking at a little bit just to see, coming out of a bigger financial crisis, a bigger crisis, a COVID crisis, we finally got to this point where the market was in a more mature uptrend on lower vol. I'm wondering if that's where we're headed for the S&P now. Chart number 2 is looking at end phase. When I'm looking at names that are working today, I'm thinking of charts like First Solar, with a nice consistent uptrend. First Solar has pulled back to its 50-day moving average, but remains in a fairly consistent uptrend. That's in the same group as this stock end phase, which is one of the top gainers in the S&P 500 today, up another 7.7% today, trading up to 230, which is getting just to the March swing high. Think about those bearish divergences we talked about in the charts of gold stocks and the charts of semiconductors. You get the opposite. You get a bullish momentum divergence right now from end phase energy. Lower lows January, February, March, higher lows and momentum, potentially giving you a bullish reversal signal. Now back above the 50-day moving average, could be further upside on a stock that had been a previous serious leadership name, has been struggling as of late. Is this the beginning of that recovery phase? Could be. Final chart, Ethereum. I mentioned Bitcoin getting above 30,000, Ethereum getting above 2,000. Ether got above 2,000 last week. I think that's a significant breakout above an established resistance level that's also a big round number. My big question for Ethereum prices, just like with Bitcoin, can it get above resistance and then hold it? So I think 2,000 is now the level of support. That's the alert I'm setting on StockCharts to monitor to see if we're able to hold that level of support. If we would fail there for some reason, I think the next support level down here just below 1,700, that's where we bottomed out in March. That's also resistance from November, also January and February. So pretty well-established level, 50-day moving average just above there as well. So if we would get below 2,000, I think that's your downside risk, but would still be within potentially the range of an uptrend. By the way, also just overbought and coming down. So a number of things have been overbought. Coming out of that overbought region means this week could be a little bit choppy. Remains to be seen. Folks, that's a wrap for this show. Thanks for joining us every weekday after the close for the final bar. All of our previous interviews, some great specials can be found at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.